All right. Let's go ahead and get started. I think most of the people who are planning to join have arrived. Thank you again for joining us today for the GASB 75 OPEB Considerations webinar. This is being co-hosted by GovInvest and Van Warden. Today we have several panelists who are experts in this field who are here to provide insights. And during the presentation, we encourage you to participate by finding the chat room and sharing any questions or comments you might have throughout the presentation. So let's just do a quick audio check. If you can hear me and see our screen today, if you'll find the chat and just type a Y into the chat box and hit return so we can make sure we've got good audio today. Perfect. Thank you, Amy and Stephen and Priscilla. Thank you, everybody, for joining us today. All right, without further ado, I will turn it over to today's moderator. We have Mark Schultz with BNI Warden. Thank you so much.
Thanks, Kristen. Greetings, everybody. Glad to be here today. My name is Mark Schulte, actuary at BNI Warden Associates. With me today is my colleague Gina Ganab and also Ira Summer from GovInvest. And we have an exciting schedule to talk about the latest and greatest in GASB 75 OPEB accounting and funding today. So briefly, what we're going to cover is just a little background, make sure that we're all on the same page. A lot of actuarial terminology can sometimes get thrown around in these webinars. And just want to make sure that we have the basics covered. After that recap, we'll turn to some of the current economic issues that our clients are dealing with currently, and also demographic issues. And then move on from the accounting considerations and really talk about OPEB funding. This is a topic that's become of greater importance to many employers and public agencies lately. So we will spend some time talking about the latest and greatest OPEB funding considerations. There will be a few poll questions along the way, and then at the very end, we'll make sure to leave some time for some questions and answers. So please submit those as they go along. So to begin with, just going to spend a couple minutes pretty briefly on a few slides talking about OPEB. And what we're talking about here is retiree healthcare benefits in general. There are some ancillary benefits like life insurance that sometimes come up, dental insurance, sometimes vision, but really this is anything other than pensions that an employer has promised to benefit to their retirees for life. And up until GASB 75 and GASB 45 before that, sometimes these liabilities weren't really accounted for at all. They were mostly unknown. But the past decade plus of the GASB accounting standards has really brought these to the forefront as far as what are the potential costs that are involved here. And so just as a brief introduction, what we do as actuaries is when we work with a plan or an employer to measure their OPEB obligations, we're trying to project out what are these costs? What are the payments going to be in the future? And if we look at this chart, I'm just going to start with a brief example of these blue bars. And we gather data on retirees and active participants. And we, based on our assumption models, try and project out what will employer is promised to pay to their retirees each year in the future. And generally what these plans look like, whether they're pension or OPEB, is kind of a bell-shaped curve here, each of these darker blue bars. They start low at the beginning of a plan. This plan itself is a little bit more mature, where the employer is expected to have to pay out almost $15 million a year in retiree benefit payments. They peak at some point in the future and then gradually decline. And the key feature here is that this is a closed plan. And under GASB 75 accounting, we're only looking at the current plan population. We don't anticipate new entrants. And that really differentiates it from funding, where you might have to take a little bit longer term perspective. And Gina's going to just demonstrate or compare that to what an open plan projection might look like.
Thank you, Mark. So as Mark has described, those solid blue lines there represent a closed plan. And that's what we need to look at for GASB 75 purposes. But when you're taking a long-term look at plan affordability and sustainability, you really want to do that on an open plan basis. And that's where those green bars come in. So, for this client specifically, you can see, the green bars go off the chart very, very quickly. That's not uncommon. You definitely see liabilities with kind of an exponential growth pattern there. And, that can be really eye-opening for many employers because, maybe their current retiree payments of around $15 million, maybe that's currently manageable for them. and they're not all that concerned about their OPEB plan. But when you look at the big picture of how these costs really balloon in the future, that can really cause employers and agencies to take another look at their plan. And oftentimes with plan designs in mind, it's looking at attempting to bend or flatten or slightly reshape the curve that we're seeing there for open plan model, so that the cost will be more manageable in the future. All right, flipping to the next slide here, we're just going to give you a little bit of background on how discount rates are calculated for GASB 75 purposes. And there's kind of three different scenarios. GASB 75 is very specific on how discount rates are determined, though they're not always that specific on the assumptions that need to go into that determination. So probably the simplest and most straightforward scenario is for a plan that's unfunded. So you have no OPEB trust, and GASB 75 states that we need to use a municipal bond index rate for your discount rate. And there are several options and indices to look at for that, bond buyer, Fidelity. They vary a little bit, but they're all pretty close in their rates. The other scenario is if a plan is fully funded or is projected to be fully funded. And in that case, GASB 75 allows us to use the expected long-term return on trust assets equal to the discount rate. And in order to set this assumption, it's really the plan or the plan sponsor's decision, typically and hopefully with guidance from investment advisors on that. And then that brings us to the final, probably the most complex discount rate calculation, and that's for plans that are partially funded. We get what we call at least is a blended discount rate. And so it ends up being kind of a blend between the municipal bond rate and the investment return assumption. And I'm just going to walk you through this chart here. We've got the solid red line, or projected benefit payments. So that's similar to the chart that we looked at on the other page. Expected cash flows out of the trust. And then we've got the solid blue line, which are projected plan assets. And you can see, those start at about 6 million, ramp up to about 10 million, and then gradually decline from there. And what GASB 75 allows us to do is, for the portion of that red line where there are still projected to be trust assets, we're allowed to discount those cash flows using the long-term expected rate of return. And then on the flip side, when trust assets are expected to run out, then any remaining future projected benefit payments need to be discounted at the municipal bond rate. So that's that kind of orange section on the tail end of the chart there. And depending on how well a plan is funded, you'll end up somewhere in between that muni bond rate and the investment return assumption.
And all of the discussion of being funded, having money set aside, is actually having the money set aside in a separate trust where the money can be used only to pay for these OPEB benefits, the retiree health benefits, as they go. If you've been pre-funding and setting money aside in internal reserves for GASB purposes, they don't count that as being part of your money at all. So what you're seeing here, again, similar way of looking at it, is that the money in your internal reserves is expected to earn what you're getting on your internal reserves, which is a very low rate, tax exempt, safe, short-term municipal bond rate. And that's what that index is supposed to simulate. The money that you stick in a separate trust in most states is allowed to be invested just like your pension fund, so that you can get better returns. And so while you have money in there, the money that's in that trust is allowed to take into account the kind of returns you can expect to get from your trust. But keeping in mind that if you're going to be doing this, your investments need to match up with what your assumptions are doing.
Those are great points, Ira. And another thing I'd tack on there too is oftentimes employers might be members of a statewide pension plan where they aren't in charge of investing the assets, but they have their own OPEB plan where all of a sudden they have a big pot of money in this trust and they're charged with investing it. And sometimes the trust itself will have an investment advisor that has a more forward-looking approach. Like Ira mentioned, it'll be invested similar to a pension plan. But we've also encountered a lot of small agencies that might do it themselves. And then they have not seen this much money at once, and they're really can be reluctant to invest it aggressively. And so then they put it into really low yield, quote unquote, safe investments. And it kind of defeats the purpose of putting this money aside to try and get a higher yield on the asset. So another consideration, if you're putting aside money to fund OPEB, what's your risk tolerance? And we'll get back to that a little bit more later. Also want to point out that, in addition to the volatility of the municipal bond index rates, which will affect the liabilities, or the long-term investment return, if you're a funded plan, those who have this partially funded discount rate kind of at an added level of discount rate volatility, because that mix between the two changes from valuation to valuation. And whereas a pension plan almost always is using the investment return assumption for their calculations, OPEB plans generally have a blend unless they're very well funded. And that blended discount rate can change from valuation to valuation and can change quite a bit. Moving on to the next slide, just to talk a little bit more about investment rates of return, and we're going to get into some details on capital market assumptions later. But the process of this crossover calculation, when we look at the expected investment return, I'm going to bring up a concept here that I think CalPERS popularized with their pension buck, and this exhibit is borrowed liberally from them. It's really just meant to illustrate that pensions and OPEBs are really defined benefit obligations. And to that extent, $1 of benefit or multiples of that have been promised to retirees. And so based on your investment portfolio and expected rate of return, or I should say your actual rate of return, a portion of that benefit paid to the retirees is going to be based either on the investment earnings or on the contributions. And we just have to understand that that's a fine balance, and that if you don't meet your return expectation, that relationship can change a bit.
Yeah, so this graphic that sorry, go ahead, Ira.
Oh, no, but one of the things, and we're going to talk about this in a little more detail later, but this starts to give you the reason why, one of the biggest reasons why you want to pre-fund, put that money aside, is because if you do, most of your payments are going to come from investment return like they do on the pension plan, which means over the long term, you're going to save a lot of money by pre-funding. And we're going to talk about that. We're going to hit on that a few times during this, that pre-funding, yeah, it's good. It's good for your balance sheet, but more importantly, it saves you money over the long term if you can start putting money aside.
Absolutely. So, as Ira mentioned, the investment earnings really do the heavy lifting. So, for this graphic, what we've shown is a trust that in theory earns, 6.5% return. And so what that translates into is, for every $1 paid out of the OPEB trust, it would be financed by roughly 35 cents in employer contributions, and the other 65 cents are actually investment earnings. So, you get a spectrum of results there. If you're in a portfolio that is more aggressive, maybe you're in more equity or private equity, generally the long-term rate of return would be higher. And in that case, you would expect investment earnings to pay for a larger portion of benefits. And then, lower contributions would be required to fund the same amount of benefits. The opposite is also true. If you're invested more conservatively, then you're going to get lower investment earnings and need to put more in the form of cash contributions into the trust.
And a last item, I would be remiss as an actuary if I didn't talk a little bit about risk. And in our profession and in the investment profession too, there's been a lot of discussion over the past decade or so of, how do you justify a certain investment rate of return? And, there are some folks on the financial economics end of the spectrum that say, you shouldn't be able to bank these returns essentially when valuing liabilities ahead of time because they are not risk-free. And they've pushed for more evaluation of liabilities on a risk-free basis. but that kind of collides with the practical implications of over time, the historical result has been if you invest in equities, fixed income, whatever your portfolio might be, generally there's been a reward for taking that investment risk, and it helps reduce the financing and benefits. And it's not an issue we'll resolve on the webinar today, but just be aware that that is out there. Another kind of topic out on the not too far horizon is in our profession as well, there's a push to at least disclose what pension and along the way OPEB liabilities might look like under a risk-free rate. So assuming, say, treasury rates, a 2% or so yield. And there's been a lot of back and forth over the years, and they're finally moving closer to that when a funding val is prepared, that measurement must be disclosed. But that's really just a measurement and not maybe necessarily related to how you're going to actually do your ongoing funding. And just to kind of hammer home this point that we've been talking about with these relationships, the discount rate inversely related to our OPEB liabilities. And that's particularly important as we start looking at a chart on the next page with municipal bond rates, because expectations for both in fixed income and equity securities are generally have been declining over the past few years. And we've also seen a decrease in our municipal bond rates. I'll move ahead here. And what we have is a chart here that just shows over the past 3 years, a sample for the Fidelity General Obligation Muni Bond Index, where rates have gone. And back towards the beginning of GASB 75 implementation, we had rates that were close to 4%. Now, current measurements are around 2%, and there is some volatility along the way, but it has pretty serious implications for both unfunded and partially funded OPEB plans.
Yeah, looking solely at unfunded plans, the drop from around 4% discount rate down to 2%, that kind of translates into probably about 15 to 25% liability increase, just due solely to those municipal bond rates. So that can be a tough pill for many agencies to swallow.
A lot of agencies, as you wonder at how your costs are, how your liabilities are shifting from year to year, back to the concept that Mark talked about on the other page, lower discount rate. If you assume less money is coming from investment return, more money needs to come from your general fund. That's going to increase liabilities, is going to increase any pre-funding contributions you have with the lower discount rate. Now, the good news, hopefully, is that the economy had shut down partially in 2020, interest rates dropped to as low a level as they've been in my lifetime. And I'm saying this as the oldest person on the presenter group. There isn't much further they can go down. You're seeing that in the returns you're getting on your internal reserves. They were at 0.5%, 1%, very, very close to zero. At some point in the future, they're going to move back up. Now, that's going to have some impact on the economy and on your revenues, but at least from your liability perspective, as those move back up, you will have the liabilities drifting back down at some point in the future.
All right, so we've talked about how economic factors impact liabilities. Now we're going to switch gears to discuss how these economic factors are affecting plan assets. And, this has been a hot topic for pension plans for several years. It can be a source of great tension among different stakeholders, as I'm sure many of you are aware. As we mentioned earlier, there's that inverse relationship between the discount rate and the liability measurements, which, really makes a higher investment return assumption desirable for both funding and accounting purposes. But, unfortunately, despite, recent high stock market returns, investment advisors generally have a much more pessimistic view on future investment return expectations. And, these capital market models and assumptions, they're constantly evolving as new information comes available. So it is really something that we as actuaries, strive to stay on top of, as well as I'm sure all of your investment advisors, quarterly are meeting with you to discuss some of this stuff. But, just a quick example, I worked on an actuarial experience study a few months ago. And at that time, as part of the study, we included our best estimate of a long-term expected rate of return. And now a few months later, just last week, I had to present those results to the board. And the week prior, there was a new capital market survey was released, and we had to revamp our best estimate. And that's not necessarily a fun discussion to have, but things are constantly evolving, and this evolution has really created some difficult choices for many plans and employers.
And the graph here, while it looks like people are getting less and less optimistic about the markets, part of what that graph is saying is related to the graph that we saw before, because about a third of this hypothetical portfolio is in fixed income. And if fixed income rates have been dropping over the last, they've been dropping over the last few decades, but they've been dropping over the last few years, then if a third of your portfolio is going to be earning close to nothing, to 1%, then your chances of making 7 become very, very difficult. That the rest of your portfolio, the other 2/3, needs to earn at least 10. And while we get years like the fiscal year that just ended, where you get that, that's not going to happen on a regular basis. People believed it in the 90s. We found out we were wrong. And so unless the economy is pushing forward and growing and being more productive at a phenomenal rate, the markets are not going to be able to sustain 10% per year every year on average for the long term.
Yeah, those are good points, Ira. And I just add a little more detail too. This information is from a sample portfolio that another firm, Horizon Actuarial Services, they actually deal mostly with ERISA multi-employer plans, puts out each year. But they do a great survey of investment advisory firms. And I think there's almost 40 firms that respond to this survey. They collect this information, and many firms refer to it as sort of one source of expectations on investment returns. And what they've done here is developed kind of a hypothetical portfolio for a standard multiple employer plan, which actually probably isn't too far off from a public sector plan, where they're a little over 40% in equities, a little over 30% in fixed income, and then about 25% into different private equity and other alternative asset classes. And really this movement to the alternative asset classes is a drive for returns. There are these assumptions that they've had for a long time about what their investment return assumption is going to be. And as Ira mentioned, with declining fixed income yields and declining expectations on regular equities, a lot of plans are searching for that return someplace. And in this example in particular, based on the new assumptions, the expectation about a 50th percentile on average that this plan would earn about 6.25%. And so what they've done is say, well, on average, plans with similar portfolios are actually assuming about 7%. So what is our confidence that we're actually going to reach these goals? And as I've highlighted here in the survey average, a few years ago, they were relatively confident, over 50%. That's dropped this year to below 40%. And I think it really should give plan sponsors pause as far as if we're less than 50 or even 40% confident that we're going to hit this investment return assumption, is it really reasonable? And our jobs as actuaries really, when we sign off on reports, is to say, do we think that the assumption chosen by the employer with their investment advisor is reasonable? And so we have to use our professional judgment and models. But ultimately, this is the decision that needs to have some input from the investment advisors. And oftentimes, they're not asked enough about what their expectations are. And we just encourage anyone that is invested with, has invested pre-funding for their OPEB plans to talk with their advisor about what do they think these portfolios are really going to earn, because that's really the starting point for this conversation.
And that time period, and it's showing up in green on the graph. This is a 20-year time horizon on the graph. This should be, and that to me is sort of the beginning of long-term expectations. 20 years, 30 years, is what you're going to be looking for. The fact that they may believe that the markets in the next year are going to do phenomenally well is nice. It's interesting. It may impact your short-term decisions, but your assumptions should be based on the time horizon of the benefits that you are paying from the trust. So if you are expecting to use the money in the trust to pay these benefits over the next 20, 30, 50 years, that's the kind of time horizon you should be using for your assumption on investment return.
Yeah, that's a great point, Ira, and also highlighting the fact that we've had good returns the past few years, and I think people quickly forget some of the volatility of the early 2010s, 2008, 2009, and the move from a historical average perspective to really forward-looking assumptions in the investment profession and the actuarial profession. It's been a complete evolution the past decade or two, where folks used to say, well, what is our expected return? Let's look at what we earned the past 10 or 20 years. The conditions that produce those returns might be significantly different than the conditions that are around now. And so we have to look on a forward-looking basis. Just one other anecdote I want to share too on this topic is had a discussion recently with a director at a statewide plan, and they're getting some push to reduce their investment return assumption. And we were talking about the timing of it. He said, this is really almost the ideal opportunity to make this decision. We're at a point where the markets are relatively high. We've had great returns. Our funded status has improved. Yeah, it would probably look better if we kept our old assumption, but when are we ever going to have a better opportunity to change this investment return assumption and not have it substantially increase contributions to the plan?
Okay, current demographic issues, something that's on top of everyone's mind these days, COVID-19. Before we dive into this topic, I want to be respectful and acknowledge the fact that, this pandemic has been and continues to be devastating for so many people on many levels. That said, for the purpose of our discussion today, we're going to focus on the impact of the pandemic on plan sponsors and specifically, plan costs and liabilities. As we mentioned here, the effects are really unclear. Long story short, it's really difficult to speculate, what COVID's effect will be. And a big part of that is kind of due to some conflicting changes. And, plan sponsors have come to us and said, hey, what is this going to do to our liabilities? From their mind, possibly there's higher mortality with, more people struggling with the virus. But on the flip side of that, there's also the argument for possibly survival of the fittest. So, those who survive the pandemic, are those folks healthier and will therefore possibly live longer than we were previously expecting? Along the same lines or similar lines is, modern medicine and the miracle of modern medicine. Are there going to be significant developments in vaccines that would increase future life expectancy? We don't know, but it's good stuff to think about, definitely. Another thing that's come up is healthcare claims costs. Currently, plans are probably seeing higher than average claims costs due to more hospital use and whatnot. Which drives up plan costs for OPEB plans. On the flip side, again, kind of going back to the survival of the fittest, long term, will those medical claims costs actually be lower because people in general will be healthier? It's very difficult to say, difficult to speculate. Epidemiologists and other experts are still trying to understand this first phase of the pandemic, let alone the new variants. And we're not going to know the effect of this pandemic on mortality for quite a while. So actuarial models will at some point be able to reflect some of this, but it's going to take a while to get there. And I think one thing that comes to mind specifically for public sector employees is, they may not see, for our clients in particular, we haven't seen a huge spike in one-year mortality. And some of that may be because public sector retirees are more likely to have healthcare coverage versus their private sector counterparts.
Yeah, Gina, and also piggybacking off that too, how COVID has affected other assumptions that go into these actual evaluations. And the one that really jumps out and where we have started to see some anecdotal evidence is on retirement rates. There's been documentation of folks are generally retiring a little bit more early, that there's been more early retirements. And from an OPEB perspective, this is generally going to increase liabilities. On the pension side, there's often a reduction if you start your benefit early, but on OPEB, it's usually a fixed dollar amount. And so if you have more folks retiring early at an earlier age, they're essentially just getting these benefits for a longer period of time. So that's one to particularly keep an eye on as far as how your OPEB plan might be affected by sort of what's currently going on in the demographic environment.
Although in a lot of cases, I think it's going to be a while before the demographic experience from our COVID years, which I hope ends soon, gets sort of phased into the overall experience. Because realistically, there's no expectation that we're going to keep having pandemics over and over and over again, although it does feel that way sometimes. But if we're not, then the higher mortality rate is not something that's going to be repeating over time. That the turnover in the retirement, as Mark just talked about and we're showing on this slide, where some agencies across the country had to lay off a bunch of their employees, put them on furloughs, that some employees responded by retiring, figuring if they're going to be stuck at home anyway, they might as well be retired. So those kind of things are not necessarily going to be repeated, but the change in the work environment that I think is going to be more permanent, with a lot more people working remotely now than they were before, is probably going to have a long-term impact on turnover, on retirements. The thing is, I'm not sure whether that's going to make retirements happen sooner or later. And it's going to take a little while for us to see what is there and not just guess. And actuaries hate to guess.
Yeah, I entirely agree there, Ira, and especially your point about, are these going to be recurring? That's really challenging to speculate about. What we expect is more, there might be a couple spikes here and there the next couple of years with some volatility on the liabilities, but whether that recurs, it's probably unlikely. But if there's a wave of pandemic, it might induce a certain behavior, but you're entirely correct that it's probably not going to repeat itself in perpetuity in some of these assumptions. Ira pointed out a couple of these other ones that are reviewed as part of the actuarial process. Future plan participation is one that is a very powerful assumption. Again, kind of difficult to understand how this might be affected by COVID-19. My gut feeling is that, we deal with many plans where not necessarily all retirees participate in the plan. They might have other ways to get healthcare coverage. So we can have some plans that don't have really high participation rates, but COVID might be exposing that, hey, this is a good deal. I want to stay on these plans. So I wouldn't be surprised if we see an increase in participation, even if it's gradual. And then changes to our overall healthcare system. I get asked about this once in a while from agencies of, well, aren't we going to go to national healthcare soon anyways? And I just kind of pause and say, well, I don't think we're going to get there one fell swoop. This is, if anything, there'll be incremental change. I wouldn't bank on it as far as managing your OPEB plan, but it is an issue to consider, especially as we start looking at these projections we do in our actuarial liabilities, which is, I pointed out earlier, 50, 80, 100 years into the future, a lot can happen to affect those liabilities, and we adapt over time. I'd say this kind of highlights also the one of the main differences between pension and OPEB costs and how they're managed, which is pensions are much more stable than, say, an OPEB liability. There's many fewer factors that go into projecting pension costs. There's not necessarily an alternative way of providing that income. Many of the benefits are vested and are pretty determinable. OPEB, there's just so many more things that go into these cost calculations that we tell our clients when we prepare OPEB liabilities, you have to expect volatility. It's going to happen much more frequently than with pension plans. And this is going to kind of lead into our next discussion on OPEB pre-funding and some of the issues to deal with.
All right, thanks, Mark. So, we've listed out here a few of the many reasons to pre-fund OPEB. Benefit security is huge. Having a pre-funded OPEB plan would be, I imagine, viewed very favorably by employees, and could definitely help with employee retention. It's also just good general fiscal policy, which is something that is generally a taxpayer's concern. And going back to what we touched on earlier, having affordable contributions, that is huge for employers. And having an OPEB trust allows you to harness the potential investment returns. If you think back to that OPEB buck, I think we were calling it, 65 cents of every dollar could possibly come from investment returns versus 35 cents of actual cash contributions from the employer. So to the extent you can pre-fund, you can harness that potential. And what we've got here is just a chart to kind of illustrate what we've been talking about with the idea of pre-funding. And so these gray bars show the idea of retirement savings. And I think of it, this obviously applies on a plan-wide basis, but it's very similar to an individual saving for personal retirement income. The idea is that you will accumulate funds over your working lifetime, and that by the time you retire, and for example at 55 on this chart, that you will have enough funds such that the goal is you can kind of set it and forget it into retirement. And so what you see here is this gray chart is, in theory, accumulated retirement savings. And then once you get to the green bars, I kind of think of as a balance of sorts. So you've got this account balance, this savings, and it's still invested. So while you may be paying benefits out of that trust, you're still earning an investment return. And for the first several years, the trust is big enough that it can mainly cover the withdrawals from a trust. And then you can see it, starts to gradually decline over the course of a few decades. And the idea is that, you would essentially run out of money at the end of someone's life expectancy. Obviously we don't have models that work perfectly. And as Mark has mentioned, sometimes it's easier to hit this target for pensions than it is for OPEB, just due to some of the volatility. And Ira, this was a chart that you provided to us. Is anything else you want to touch on here?
No, you got the whole thing again. This is the concept for pre-funding for OPEB comes from the same place as does for pension. Theoretically, agencies want to pay for the benefits you're providing while you get the services from the employees. So while they are working, while you're getting value from them working, you're giving them their pay, you're giving them their regular health care, and then you're pre-funding their pension. You should be pre-funding their health benefits also, so that the taxpayers who are receiving benefits from them are the ones who pay for their benefits. So over time, by pre-funding, you're allocating costs to the right time periods. And that's what this graph is doing. It's also, and then rewording some of the things that Gina talked about before. Again, good, it's cheaper. It is also good for your credit rating. We've worked with a number of agencies whose, when they saw their report card from the rating agencies, the thing that held it back from being a higher rating was the fact that their OPEB plans were not being pre-funded. So by putting money aside, by showing the responsibility, by showing you're taking care of these liabilities also, it's also going to help your credit rating, so that if you need to go out for some sort of debt financing for infrastructure or something else in the future, you've saved money on that because you put money aside for this, which ultimately saves you money on the OPEB side.
Good points, Ira. And as we talk about this pre-funding, we want to kind of transition into what does an OPEB funding policy look like? And it's no surprise that it's going to look a bit like a pension funding policy. And to me, the key is always this normal cost concept, which is the value of the benefits that are earned each year. So if we kind of flip back to this chart, it's the incremental change in each one of these bars as the benefits are accumulated. And ideally, if the normal cost is funded from day one of a plan for all the participants and you meet all your assumptions, that's all you'd have to contribute, just be the normal cost each year. But inevitably, there's going to be changes from actual experience versus expectation that may lead to an unfunded liability. And for many agencies, this is kind of the bigger piece of the puzzle as far as how to pay down the unfunded OPEB debt. And already OPEB starts kind of in the hole compared to pensions, because pensions have been funded or pre-funded generally for many years. OPEB, prior to GASB 45 coming on the scene, was not really managed much. And so as agencies start looking at pre-funding their OPEB, they're generally faced with, oh, I'm starting with almost an entire unfunded liability to begin with. How do I pay this down? And that can be a challenge. You really have to think long and hard about how are you going to deal with this unfunded liability amortization payment. But in general, what we want to do is pay off the current year's costs that are accruing, the normal cost, and then start to chip away at the unfunded liability. And there are many ways to do it. One I will professionally not suggest is it became prevalent during GASB 45, which was the ARC. And it was a quasi-funding measure with a 30-year amortization, generally re-amortized each year. And surprise, surprise, you never really paid down your OPEB debt that way. It just kept kicking the can down the road. And there's been a lot more guidance, both in the finance and actuarial professions, about what are really good models for funding policies. Generally start with amortizing your debt over a closed period of time. That's the number one thing, so that you have a fixed end period, and it shows that you really are targeting a way to pay down the pension debt or the OPEB debt. Another one I always think of too is your contributions or payments should at least be equal to the normal cost at the very minimum, because otherwise you're just digging an even bigger OPEB debt hole if you're not even funding the OPEB or the normal cost. That might be covered if you're already making payments out of your general funds for retiree payments, but contributing the normal cost in some sort of methodical way to pay down the unfunded liability.
And as Mark mentioned, there are a lot of different approaches for developing a funding policy. We're not going to get into all of that and all those details today, but we do want to highlight, as we noted on the first bullet here, that GASB 75 really incentivizes plan sponsors to have a legitimate, official OPEB funding policy, so that you're able to use that long-term rate of return as your discount rate, which means higher discount rate, lower liabilities. There's your incentive from GASB 75. That said, unfortunately, GASB 75 doesn't provide much guidance as far as developing an ADC for actuarially determined contribution. So, we recommend that you work with your actuary to develop an ADC that's manageable, sustainable, and, meets your objectives.
I think that'll bring us to our first poll question, which is, how many of the attendees actually have a formal OPEB funding policy? And a very spectrum of answers are possible.
So answer now. And yeah, I mean, my guess is going to be that we have the agencies, the people who are attending here are more interested than most in OPEB, just by the fact that you're here. So my guess is that that we're going to have a majority of our group having some sort of policy or pre-funding. But I'm going to find out that I'm wrong in a matter of moments when we get the real data. So this is where Max is in control and he makes us wait.
A few more folks are still just bubbling in here. I'll wait another few seconds.
Okay. Survey says. All right.
Not too bad. is kind of what we see too, and a lot of the clients we deal with, which is that, there's kind of an ad hoc contribution policy for OPEB plans. Some are really starting to explore it, and many just don't know either. There's been some money contributed to a trust, and a change in staffing and leadership, and it's like, okay, we've got this money out there. Do we really have a policy or not? And it's just something that it deserves some attention. I think that would be my takeaway on it. I don't know, Ira, if you have any other comments on the results here.
Yeah, it's again getting started for some of you, not knowing how to get started holds you back from that. And again, whether you talk to your actuary or you use our software to help look at models, that can help you get on the path. And the concern about committing is another one. But as Gina talked before about having a legitimate policy, which in my mind is having a policy that works, that will ultimately fund all the benefits you promised, and following the policy. So that combination is what gets you the ability to get a better credit rating from the rating agencies, to be able to use a better discount rate, is that you've got a consistent policy over time where you're going to be setting money aside. The pre-funding without a formal policy is great. Hopefully that's the gateway to get you to having a formal policy over time.
Yep,
and if you don't know, there's nothing wrong with not knowing.
Yep. Well, we're going to probably pick up the pace a little bit. We have a few more slides, but we're already running a little short on time as far as the additional funding policy items we want to talk about. And Gina, you want to touch on the big question: how much is too much for OPEB funding?
Yes, absolutely. One of the interesting quirks about OPEB funding is that it's just operationally different than pension funding. Pension plans definitely, generally have, a substantial trust built up, and they're paying their pension payments directly from the trust. Contrast that with OPEB plans, where, funding is relatively new in general. And, if agencies are paying benefits out of their trust, typically it's a more convoluted process. They're generally, first it's paid out of general assets, and then agencies reimburse themselves from the trust. And I think this goes back to, OPEB plans when they first started funding. The focus is on accumulating assets, as Mark mentioned earlier, digging yourselves out of the hole, which is, very important. But, maybe didn't consider some things such as, well, when do we pay retirees out? How do we pay retirees out? What type of assets will we use for that? Sticking to the topic on this slide, it can be easy to forget that, these benefit payments are coming out of general assets. And what we really want to hit home here is to touch on the subject of hyperfunding. And what that essentially means is when you have a gross ADC number, so your whole actuarially determined contribution, what you're allowed to do is to essentially credit yourself for any of the pay-go benefits that are not reimbursed from the trust. And where things get a little sticky is for agencies who aren't doing that, and they're kind of hyper funding, essentially putting in the full ADC contribution as a cash contribution into the trust, and not recognizing that they get credit for these unreimbursed benefit payments from general assets.
And if you can afford to pre-fund at the faster rate, which is by paying the money to pay the unreimbursed benefits and paying what was the initial calculation for the actuarially determined contribution, you may want to consider having a shorter amortization period, so you realize and you are explicitly doing what you think you are doing. If you're just accidentally overfunding by double paying, by paying the benefits from your general fund and making the full contribution to the trust, then that's great. It's great to be pre-funded, but you're not following your policy. So make the decisions. Again, this is all about making the right decisions that's right for you, and then following the policy.
Those are excellent points, Ira. And kind of brings us to our next poll question of, how do you finance your current OPEB benefits to retirees? Most cases we see OPEB trusts aren't necessarily allowed to pay directly to retirees, but then it's a question of how are you reimbursed? We do deal with a few trusts that do pay the benefits directly to retirees, but oftentimes OPEB trusts are just fundamentally different than a pension trust. All right, Max, do we have results yet?
Yeah, we have a few more still coming in, so I'll give it about another 15 seconds or so.
Okay. All right, so it looks like the leader is they pay all the benefits out of general assets, no trust, so essentially a pay-go policy. But then a few responses here where there are at least some or all the trust reimbursements. So that's what we see often. We've been encouraging many of our clients with the funding policy to start looking at those reimbursements. And I think then the next slide will point out where this is particularly important. Now, we'll go through this very briefly. And this is an example of one of our clients we took over a few years ago there. They had a dedicated OPEB trust funding policy. And I forget if it was a 20 or 25 year pay down. And when we started working with them, they were already at 63% funded because they were contributing the full actuarial determined contribution, plus they were paying benefits, all the benefits out of their general assets without being reimbursed. So that'd be like if you had a pension fund where you made your contributions each year and you also made the pension payments out of your general assets instead of having the trust do it. That just does not happen. So in this case, there really are hyper funding. And I think the ratio was about 3.5 million of ADC contributions to 1.5 million of additional pay-go costs. So essentially bumping up their contributions by almost 40% per year. A couple of years ago, we convinced them to start at least reimbursing some of their benefit payments. So it kind of slowed down the growth, but that combined with the great investment returns they had this past year, they're almost up to 94% funded, and they still technically have 17 years left in their amortization policy for paying down their OPEB debt. So they're likely going to hit that very soon. And that kind of gets into our next question. I think we might have one more poll question before that of what to do when you hit 100%. But just generally, for those who have established an OPEB trust, or even those who haven't, how well funded are your plans right now, if you know? And if you don't know, well, that answer didn't get put on there.
The other perspective, back to the previous poll question, while you're filling this one out, is, especially early in a funding policy, for those agencies that have just recently implemented their funding policy and are starting to fund their trust. In order to fund your trust, you need to be putting aside more money than the benefits that are being paid to the retirees. So knowing that consciously you are making the payments from the general fund for the retirees and then taking something extra and setting it aside for the future allows you to consciously see that you are putting money in the trust. At some point in the future, just like a pension fund, you're going to be using the money from the trust. But if you start doing that in the beginning and you're not paying close attention to the fact that you should be setting aside more money in order to have this start to grow, that may be one good reason to continue paying, at least initially, the money from the general fund, so that you and your councils, your boards, are all consciously aware that you are pre-funding and putting yourselves in a better position. So funded positions, I'm not sure how many of the unfunded are really people who don't know, but it looks like a lot of them, 73% are under 50%. So they're either not funded or just starting to fund as these things move forward. It's nice to see we've got a couple that are in the 80 to 100%, and no one's willing to admit that they're overfunded. But with the returns that came in this last year, I think next year when we do this, we're going to see some people in the over 100% category.
Yep, and I think that brings us kind of our next topic. Gina's going to quickly talk about just anticipating this so you don't get there and all of a sudden have to scramble to figure out what to do when you hit 100% funded status.
Absolutely. So 100% funded, now what? And, I think this wasn't anticipated when a lot of people probably created their funding policies, especially since amortization periods usually range from, 20 to 30 years. So the end goal of reaching 100% funded status, really seemed like a far off fantasy when, a lot of trusts were created. And the things that we want to point out here is just, to be realistic about the fleeting nature of that magical 100% funded status. You could be 100% funded one year and then the next year have some, plan experience changes, assumption changes that cause that percentage to drop. So, it is always kind of a moving target. Things change quickly, and so your funding policy needs to be adaptable. Going along with that, how much of a funding cushion before contributions can stop? We really do recommend to continue to fund the normal cost so that you're not adding to the unfunded liability and not adding to that hole. And, it may be reasonable to stop those normal cost contributions once you've reached, a sizable funding cushion, maybe something like 120% or higher. But, you really do want to discuss that with your actuaries or use the GovInvest software to make sure that, once you decide to turn off those contributions, that you're able to kind of set it and forget it and ride it out. Also, you do want mechanisms in place to restart contributions if things don't go as according to plan and you need to start putting money into that trust again.
And from a budgetary perspective, it's always difficult to go from having nothing as a line item to having something as a line item, which is one of the good reasons to keep funding. The other thing to keep in mind from this is 100% funding is not, if you think of this like the mortgage on your house or the payment on your car, when you have paid off your mortgage or your car loan, you stop making payments. And for some board members, that's what they think is going to happen when they hit 100% funding. All that means for the pensions and OPEB is that your past liabilities are covered. You still have as long as you have new employees coming into the plan each year and earning additional benefits, you have normal costs accruing, and you should be making normal cost contributions to pay for those benefits as they go. So it's not going to make your contributions to OPEB go down to zero unless you shut the plan down. The plan's continuing and the employees are still getting benefits. You're still going to be paying for benefits as they go. But that's the theoretically ideal way to be doing this, paying for services as they are being earned.
Yep, great points, Ira. We're getting close to the end of the time, so I think we're going to skim through the last part. We're very enthusiastic actuaries, so we could talk about this stuff all day. But kind of on the flip side to Gina's points about what to do when you're 100% funded would be, is that even necessary? I kind of think of 100% funding as an aspirational goal, but sometimes that runs into the reality and practical considerations of we just can't afford to pre-fund our OPEB. We have mandatory pension contributions that must be paid versus OPEB funding is usually optional. There's just a lot of considerations. Plans can operate for a long time below 100% funded, but you just have to make sure that you can meet those future payments, those blue bars from the chart we talked about way back at the beginning of the presentation.
And for those of you who are really worried about Medicare for all, taking care of everything, then fine, just fund to 90%. And Medicare for, and hope Medicare for all kicks in and covers the rest of it later.
Yep. Then the last topic is employee contributions. There you go, Gina, finish us up here.
Yeah, we can just skim through this briefly. I just wanted, to mention that, it's becoming more popular. Tread lightly. I think there are a lot of, tricky nuances with employee contributions for OPEB plans, such as whether or not to reimburse those contributions. Do employee contributions, do they actually reduce an employer's ability to significantly change an OPEB plan? You know, there are a lot of considerations to take into account. And if that's a path you're considering going, I would definitely, you know, recommend discussing with a benefits attorney or, you know, peer agencies who have gone that route as well.
Yeah, we've had a few clients that have generally sprung this on us, and we go to do evaluation to say, oh, by the way, in bargaining last year, we added employee contributions. And we're like, oh, okay. And there really hasn't been a lot of measurement of what was the effect of that. It was kind of a show of sharing of costs, but I don't think sometimes they've thought through all the implications. And one of them Gina brought up with is a lot of time OPEB trusts, they aren't even legally allowed to accept employee contributions. Only employer dollars go into them, unlike a pension trust. So there's just some nuances there that need to be cleared up. So as far as what to do now, you know, we talked about some of the changes in the muni bond rates and investment expectations, to review those before your GASB 75 valuations. Now is a good time to consider those assumptions, especially with the strong investment returns. And as you move towards looking at investment or OPEB funding policies, there are just a lot of options out there, and just to make sure they align with your fiscal priorities. And talking with an advisor or a peer who's gone through this process can be immensely helpful. And with that, questions. And Max, I'm not sure if you've got those or if I've got those as far as questions people have submitted.
Sure. We have one question about the benefits of combining an OPEB and pension funding policy. It's coming from Jeff from Coachella Valley Water.
So yeah, I saw the question coming in from Jeff Keel. Jeff, always great to get your questions. So the question is, does it make sense to develop sort of a universal policy combining your pension and your retiree health plan? I think the answer to that, which is the kind of answer you're going to get from actuaries and a lot of things, is yes and no. Keeping in mind that you have different rules applying to each of these, that there are requirements on the pension side that are not necessarily on the OPEB side, that you have a lot more control and flexibility because of that in the OPEB side, but being able to look at everything together, your total funding, your total reserves that come from this, I think is very helpful. And my guess is will have a positive impact on your credit rating over time, as long as you are looking at these, with some significant funding going along with it. I don't know if Gina and Mark have any other thoughts.
Yeah, I think you hit all of them, Ira. And to me, it's all about the mandatory nature of most pension contributions and the fact that for many agencies, they're significantly increasing depending on what pension system you're in, and having the flexibility to coordinate the two, but realizing that some are going to have a higher priority than others.
So thanks for the question. And if you have more questions, we can go to the next slide and tell you how to contact us so that you can keep asking the questions after this. Because we are excited about topics like this. This comes from somebody who's about to spend the next 4 nights watching baseball. So my idea of exciting, I guess if you want to find baseball more exciting, maybe you should watch more golf. But if you want to get a hold of us with questions on OPEB plans and about funding, how to get started, how to fine tune what you're doing, you can get a hold of Gina and Mark at their email addresses at vaniraden.com, which I'm probably mispronouncing. And or if you want to get a hold of me or any of the GovInvest team, best to go through our customer success group, which is success@govinvest.com. We greatly appreciate all of you coming and sitting through over an hour of discussing retiree health benefits and their funding and their accounting implications. We will be having more webinars coming up in the not too distant future. As we mentioned before, the presentation itself is going to be emailed to all of you, so you have it. The session has been recorded, so that I can't take back anything that I've said at this point, and we're going to have the recording available to all of you. So you can just keep reminding me over and over again that I told you to do something, even if I didn't mean it. Thanks again for the Van Iwerden team. Mark and Gina, you were fantastic. Put together a fantastic presentation. They did most of the heavy lifting on this. Max, anything else we want to say before we let everybody go to their afternoon?
No, thank you so much for everyone attending. Hope you have a great rest of your week.